Well, Godwin Emefiele is the governor of Nigeria's central bank. Well, that's not news. We all know that. But that's one man that received so much hard knocks in 2016 for, in particular, the exchange rates, markets, particularly since June 15, when that new policy on floating FX market regime was introduced and went into operations a few days after. Since then, we've seen the Naira down, as you've heard, at the official window, about 30%. On the street, more than 40%, as we're wrapping up 2016. Naira dollar on the street, close to 500 Naira. That looks likely where we're going to finish off the outgoing year, or the old year. What 2017 has in store is anyone's guess. But for now, the central bank hasn't made any new announcements, and they're keeping it all quiet until the new year. So in about 3 weeks from now, around the 20th, we expect the Central Bank Monetary Policy Committee to sit together for the first time in 2017 and hold the first policy rate meeting. So let's step back very quickly and look at the last meeting in November, talking about how they arrived at those decisions to leave all key benchmarks, or what you call the key indices or indicators, unchanged, talking about the liquidity ratio, the cash reserve ratio, the corridor, asymmetric corridor, as well as the headline monetary policy rate. Let's revisit some of the things Godwin Emefiele, the head of the central bank, said in November.
Data released by the National Bureau of Statistics in August showed that the economy slipped into recession following a second consecutive contraction in the second quarter of 2016. Domestic output contracted in the quarter by 2.06%. The latest release in November 2016 by the NBS shows that real income actually worsened in the third quarter of 2016 as output contracted further by 2.24% relative to its level in the previous and corresponding quarter of 2015. The non-oil sector grew by 0.03%, following the 0.38% contraction during the second quarter of 2016, driven by agriculture, which grew by 4.54%. The MPC noted that the key undercurrents, shortage of foreign exchange, low fiscal activity, high energy prices, and the accumulation of salary arrears, especially at the subnational levels of government, continued in the third quarter of the year. Members also noted that those conditions could not have been ameliorated directly with monetary policy instruments. It, however, recognized the need to continue to set monetary conditions in such a way as to enable fiscal policy the required space to improve public investment in public infrastructure. The committee noted that headline inflation continued to rise in October 2016 to 18.3% from 17.9% in September and 17.6% in August 2016, thus maintaining the upward momentum since January 2016. The increase in headline inflation in October reflected increases in both the food and core components of inflation. Core and food inflation increased from 17.7% and 16.6% in September to 18.1% and 17.1% respectively in October 2016. The committee also noted the less rapid movement in the month-on-month CPI between September and October. Headline inflation index month-on-month rose by 0.83% in October from 0.81% in September, contrasting the successive declines since May 2016. Similarly, the core index has been increasing at a slower pace since May, when it rose by 2.7%. It moderated to 0.75% in October from 0.96% in September. A similar pattern is noted with the food month-on-month index, which rose by 0.86% in October from 0.81% in September. The MPC observed that the incessant pressure on consumer prices continues to come from structural factors including high cost of power and energy, transportation, production factors, as well as rising prices on inputs. Broad money supply M2 grew by 10.5% in September 2016, compared with 8.08% in August 2016. When annualized, M2 grew by 14% in September 2016, above the growth benchmark of 10.98% for 2016. Net domestic credit grew by 21.88% in the same period, annualized at 29.17%. At this rate, the growth rate of net domestic credit was above the provisional benchmark of 17.94% for 2016. The development in net domestic credit essentially reflected the relative growth in credit to the private sector of 20.69% in September, annualized to 27.59%. Credit to government grew by 29.57% in the review period, which annualized to a growth of 39.43% compared with the growth benchmark of 13.28%. The growth in government borrowing was largely to compensate for the continued decline in oil receipts. Money market interest rates oscillated in tandem with the level of liquidity in the banking system. Average interbank call rate, which stood at 11.5% on the 11th of October 2016, closed at 15.02% in November 2016. Between these periods, the interbank call rate averaged 11.68%. However, the average interbank call rates fell to 10% on October 24, 2016, following net government financing worth 149 billion naira between the October 18th and 28, 2016, and the payment on October 24, 2016, from statutory revenue allocation of 174 billion naira. Committee noted a decline in the equities segment of the capital market as the all-share index fell by 7.33% from 27,839.93 on September 19, 2016 to 25,797.88 on November 16, 2016. Similarly, market capitalization declined by 7.11% from 9.56 trillion naira to 8.88 trillion naira during the same period. In addition, relative to end of December 2015, the capital market indices fell by 9.93% and 9.85% respectively, reflecting the challenges facing the economy. The average naira exchange rate weakened at the interbank segment of the foreign exchange market during the review period. Exchange rate at the interbank market opened at 305 naira to the dollar and closed at 305.9 naira to the dollar between September 1 and October 27, 2016. The committee observed that total foreign exchange inflows through the CBN decreased by 31.85% from $1.4 billion in September to $957 million in October 2016. The decrease was due to lower crude oil and other government revenues in the period under review. In spite of the resumed joint venture payments in October, total outflows also continued to decrease, dropping significantly by 58.68% from $2.456 billion to $1.015 billion during the same period. Committee also implored management to continue to direct more efforts at making foreign exchange available to manufacturing, agriculture, and agri sectors of the economy by enforcing its policy directing deposit money banks to allocate at least 60% of forex available to these sectors. The MPC believes that the security agencies should sustain their checks on the activities of illegal foreign exchange operators in order to bring sanity to that segment of the market. Committee reiterated that the extant foreign exchange regulation outlaws the trafficking of currency on the streets, as some unlicensed operators currently do. Thus, to evolve an appropriate naira exchange rate that stabilizes the foreign exchange market, the BDC operators must strictly observe the terms and conditions of their license. The committee assessed the fragile macroeconomic conditions and the strong headwinds confronting the economy. In particular, committee considered the implications of the twin deficits of current account and budget deficits, the rise of nationalist sentiments across the West, and implications for national elections in France and Germany, as well as the forthcoming referendum in Italy. Other considerations include the yet to be unveiled long-term uncertainties of Brexit and expectations of significant shifts in U.S. economic policy. Committee reaffirmed the urgency of prioritizing the diversification of the Nigerian economy, given the gloomy protectionist outlook of the global economy. Committee also evaluated the impact of its July and September 2016 actions on macroeconomy, noting that while foreign exchange inflows into the economy had improved significantly in July and August, it declined after the September MPC meeting, leading to rising inflation and increasing negative real interest rates. However, outflows significantly dropped, lending credence to the propriety of the decision of July and September MPC meetings. The MPC reiterated the limitations of monetary policy in reversing the current stagflationary conditions in the economy, which it traced to supply and demand shocks. Members stressed the need for a robust and more keenly coordinated macroeconomic policy framework that will restart output growth, stimulate aggregate demand, and rein in inflation expectations. Consequently, the MPC welcomes efforts at resuscitating planning, noting the progress made in developing the medium-term economic recovery plan. The MPC urged the government to urgently assess the extent of its indebtedness to domestic economic agents and develop a framework for securitizing the debts in order to settle its outstanding domestic contractual obligations, which cut across all sectors of the economy. These accumulated debts have slowed business activities of economic agents, most of whom are indebted to the banking system, thus compromising the integrity of the financial system. It also advised the bank to commit to greater surveillance and deployment of early warning signals in managing the banking system. Overall, members called for an enrichment of fiscal and other sector initiatives and interventions towards resolving the growth challenges in the economy in order to promptly revive confidence in the economy. Available data and forecasts of key economic variables indicate that the outlook for growth and inflation in the medium term continues to be challenging. Growth is expected to remain less robust given the absence of sufficient fiscal space, while the current tight stance of monetary policy and improved agricultural harvest are expected to contain further price increases and moderate price expectations, as the trend has already revealed.
Those were the final words of the Monetary Policy Committee of the Nigeria Central Bank in 2016. We have a lot to talk about in the days ahead about those decisions and what they mean for the future in 2017, to be precise. But you hear some of the details there as a reminder, as it were. Now we'll get back to the market. The stock exchange was quite optimistic when the 2016 started, but looks like things are ending on the pessimistic side. How are we starting the final 3 days of 2016? Stick around. We're back in 2.